Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
And welcome back. Man, I took one of those cheap flights. I will never do that again. Those 30-year-old airplanes are vacuum tubes. That means the air is compressed up there. They're pressurized, and they circulate the same air throughout the plane for the entire flight. I forgot about that. I got so sick. I was down for, I can't even tell you. All the way up until the day of the seminar, I was probably sleeping 12 to 14 hours a day. And I'd get up and go back to bed. So I'm better now. But just remember, you have the option when you schedule your flights. I think United's got the youngest fleet, and I always try to get the newer airplanes. I'll even call them and ask them, because they have the air filtration systems, HEPA certified, and all kinds of good stuff on the newer planes. The older, cheaper planes, wow, that's just brutal. That brought back a whole lot of memories. Anyway, so I just wanted to talk about a few things today. We're going to be looking forward to, I think, a good, strong, growing economy. That's beyond question on almost every count, every category. Maybe slightly higher interest rates. I know a lot of people are probably extremely ecstatic that interest rates are going up. I wouldn't be too ecstatic. They'll probably go up a little bit more. I'd be surprised if they get much higher than 3.5%. But that's a long way from where they are right now, another 1.5% or so. Remember, every time they do that, the government's got trillions of dollars worth of debt, and a lot of it is refinancing. That raises up the interest costs by tens of millions, even hundreds of millions, even billions of dollars. So when the government already owes a lot of money, every time they raise interest rates, it's going to cost the government that much more money when they're refinancing the debt that's coming due. So, and that would slow down the economy. So it's kind of good. I mean, it's like a governor, and it's tricky. I would not want to be the person having to make those decisions as to raising or lowering interest rates. But right now, things are pretty good. Interest-bearing products have actually not done that well. They haven't crashed or anything, but they're down a little bit. It's not that big of a deal. Probably be down a little bit more as interest rates go up, depending on what you're investing in. You got to be very, 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 very careful in that area. We'll talk a little bit more about that later on today's show. And I did want to thank everybody, by the way, that came out on Thursday for the seminar. There were actually quite a few people there. I was really surprised. I thought it would be almost empty. But I had a few people there. And I forgot to do the drawing. So I've got all the cards, by the way. And we're actually going to put all the cards in. And on Monday, I forgot to do the drawing for the Chromebook. And I've got a Chromebook that I was supposed to give away, and I still have it, by the way. It's brand new, and it's pretty cool. It's basically a laptop, with the Google operating system on it. So we're going to give that away, and I'll let you know. I'll actually email the person that wins it, and I'll let you know next week who won that. But this is not wasn't one of the cheap ones either, by the way. It's got a touch screen. It's 15 inches backlit keyboard. It's almost a fully functioning laptop. It cost about as much as one, but it's got all the Google stuff on it. And the reason I'm doing that, I think this year, we really need to be paying attention. I've got a theme for my business, is paying attention to what you're doing. That's the theme. Being able to set your accounts up online so you can have easy access to them. Being able to evaluate the risk that you're taking. And when I talk to people, it's hilarious. Sometimes they hand me a spreadsheet that's got all the investments on it. Like, well, that's great. the how much risk you're taking. Yeah, I know it's a very difficult question to answer. Well, we've got a tool. In addition to all the other tools that we have. By the way, we've got a boatload of them. If you ever want to come in the office and take a look at it, no problem. I'll be glad to show it to you. But this one particular tool can take your holdings, can take your 401k, can take your IRAs, and look at all the holdings in there, and it can tell you basically how much risk you're taking. It'll show you. You can do what ifs. It'll do a my computer is driving me nuts. It's interrupting me here. Interrupting my train of thought. Sorry about that, people. The computer's telling me it's installing a bunch of stuff while I'm sitting here in the radio station. Great. So anyway, the software can take your holdings, tell you how much risk, show you what those things would have done, how much they would have declined during the big correction from 2007 to 2009. And I think that's a really important thing to be able to do and be able to know the how much would you go down by if we had another one of those. It does some other things too. If they raise interest rates another 1.5%, kind of like what we're talking about, how will that impact your portfolio? Now, this is a big one because an awful lot of people have been buying preferred stocks and funds that invest in preferred stocks because the yield's right around 5 or 6% or so, thinking that this is safe. And I got to tell you, that it's not safe. Those are not safe. If you have a 5 or 6% yield from something that's an investment grade, something that's a high quality, and interest rates start going up, that high quality bond or preferred stock's price is going to drop probably fairly significantly. And I'm talking about 15 to 20% or so. And it's already down. I mean, if you look over the last few months, in fact, let me pull one up here. This is one of my, that's not it. This is an income, prime income fund. Yeah. And you know what? I'll actually have to do this during the commercial break and then talk about it because I don't want to make you wait. You're out there driving and I'm here trying to look up information on a live program. But and by the way, it just dawned on me that I should probably show you that. So it's not something that I'd planned on. But I think it's very important that you know fixed income has high risk to it, even government bonds, especially government bonds. Government bonds that are long-term in nature. All right, since I brought that one up, that one's easy to pull up. The 20-year Treasury bond fund from Bond Fund holds 20. The symbol is TLT. It's down about 8.5% in the last 6 months. So the yield on it was right around 3% at the time, which everybody was. That's why they were buying it, because they were looking around. Oh, it's government bonds, 3% yield. Okay, now it's down 8.75%. So you're going to have to wait if you're reinvesting all the income. It takes you 3 years to get your money back. And it's actually probably going to drop a lot more than that over the next 12 to 18 months if they continue to raise interest rates. So that's what I'm talking about. There's a lot of risk in fixed income. You have to be aware of that stuff. As far as stocks go, there's only one sector or one classic category of stocks that's overpriced, and they're not overpriced by that much, maybe 25, 30% or so. Well, I mean, which is a lot for most people, but this is just one category. And it's the category that's done the best. It's large cap growth, and it makes up a big chunk of the S&P 500. It's one of the reasons the S&P 500 has done so well over the past 4 or 5 years. There have been lots of stocks. Now, that probably doesn't last that way forever, incidentally. And if you've been lucky enough to have some of it, and then you probably want to start looking for other places for that money. So that's what I was talking about with when you're looking at the risk that you're taking, what kind of risk are you taking? How do you know what kind of risk you're taking? Well, one of the easier ways is to buy a really expensive tool like the one I just did and put all your holdings in there and let it show you what could potentially happen, if certain things happened again than it happened in the past. Okay, so that's one way of doing it. Another way of doing it, and we're going to talk about this in great detail now and in the future. Another way of doing it is looking at the stocks in your portfolios. And how do you do that? Well, if you have Morningstar X-ray tool, if you have I think there's a free version of that online somewhere. It comes with part of my subscription to the professional version of Morningstar. You can see what your holdings are and what percentages they are of the accounts. It'll tell you that. And then you can see how either undervalued or overvalued those stocks are. It gives you a pretty good idea of how much risk you have in the portfolio in addition to this other tool. And I kind of like that one because it's relatively easy to do once you know how to do it. When somebody shows you the shortcuts, which we'll be talking about at the next seminar that I do, we're going to be talking about the shortcuts in evaluating your investments. Because I have people coming. In fact, I'm pretty sure there was a financial planner. I was laughing. He was asking a bunch of questions, good questions, same questions that a typical financial planner would ask at a seminar. A financial planner who doesn't manage money for a living, because some of the things he was saying, I was like, oh, this is funny. He's already got this ingrained in his brain. Brain is shut down, not open to new material. Well, I hope that never happens to me, by the way. But anyway, a nice person, I'm sure. And at some point in time, these are minor issues anyway. I'm sure what he was talking about is going to be fine for the vast majority of his clients. But being competitive, I like to know, exactly what I'm doing. The whole 100%. I don't want to pass on the 5%. That's the hardest part. Knowing what I mean by that is it'll take me too long to explain. But anyway, and he was talking about certain things, and I'm laughing about it. And I'm like, man, that is a tough way to go through life. That's it. I don't know any easy ways to go through life, by the way, but some are harder than others. So I'll just leave it at that. Nice guy, I'm sure, and the information you get out there, a lot of the information you get from financial planners, investment advisors, there are an awful lot of people that go through life that are really good memorizers. Not so much on the critical thinking part, where you have to break it down yourself and figure out what answers are when the answers are in the books. And you can get a PhD being a really good memorizer. I had an uncle. This guy had a nearly photographic memory. The guy never got a B. Never got a B on anything because his memory was so good. He could read something and retain it. And he had several advanced degrees, had done a ton of different businesses. And, he knew it. He would tell you, hey, I've got a really good memory. I'll read something and retain it and can answer questions on it. Because I feel bad for the people that have to work hard. He actually had a real Southern accent too, by the way, which I'm sure drove a lot of people nuts. But anyway, at least he got that part, and it's hard to know. It really is difficult to know. Do you know the answers, or did you just memorize them? Because if you've just memorized the answers, when you come up to a situation where there hasn't been an answer written down yet, because nobody's had to stop and figure it out, you can have a problem. Everybody has problems, by the way. And a lot of the answers have been written. In fact, the software that I'm talking about, where you try to evaluate how much risk you're taking, this is a tool that I thought should have come out years ago. I used to actually have several versions of it that are things that I put together, having to piece together parts from various software packages, understanding, wow, there's something that's missing here that I think the public needs to know. Like, if I put my money in this, what are the potential side effects? What are the potential outcomes of doing that? Now you can take a piece of software, put your portfolio in there, and it'll show you. And this is something that we'll be doing. We're going to be offering this. I'm going to put up a page on my website. You'll be able to sign up for that. It's a service that we're going to offer our clients at no cost. I think it's really going to help. I really think it's going to help. Because the number one thing that I don't think it'll stop basic human behavior, by the way. Humans love to chase performance. Let's go into the thing that's just gone up the most. Now, they don't sit there and monitor it and make changes. See, that's the problem with that. When you don't monitor that and make changes, when the leadership changes and you're not changing, you've got a problem. Because things that tend to do very well, that outperform by a lot, guess what they have a tendency to do at some point in time? Yep, you got it. They tend to go down a lot. Okay, so you'll capture that too if you're not careful. And putting some money into something that's done well over the past 4 to 5 years, not a really good way to manage your money for the long run. If you're in the super long run, where say 20 years or longer, okay, it'll level out. You won't have that big of a problem. If you don't have a 20-year time horizon, that is a horrible way to pick your investments. That is a horrible way. So part of what we'll be going over now in the future is how much risk you're taking. And incidentally, there are 3 risk levels for the average investor. The first risk level is the risk that you're taking now. Do you know what that is? The second risk level is the risk level that you should be taking based on your personality. And this service that we have, we'll send you an email. It's about 5 questions. We can evaluate very quickly what kind of risk you should be taking. Then we can compare that to the risk that you're actually taking. And then there's the risk that you may need to take to be able to reach your financial goals. Now, occasionally, all 3 of those are one and the same. That's somebody who's really sophisticated. They got it. They've got it down. The vast majority of us who aren't really sophisticated will have some sort of deficiency there somewhere. And I see it's all over the map, by the way. I've had people come to me and tell me, yes, I'm very conservative. I look at the portfolio like, what? Those are not conservative funds. They have stocks in them that are selling at valuations that, nosebleed territory. Wow, I can't believe the first section's almost over. I hear the music. That means I'm going to have to take a break and come back after these commercial messages. You listen to Bill Bullington right here on 1420 The Answer. Stay tuned. Oh, well, that's interesting. Little mood music there. Hey, if you have a phone call, question, or comment, 216-901-0945, 216-901-0945. Feel free to give us a call. And, I'd started to talk about a little bit about picking stocks and being able, well, not picking, but being able to evaluate a stock as a helpful tool to evaluate the risk that you're taking inside of the funds that you own. And I think it's a good idea. I think it's a great idea. We're going to start to hold some classes on that. They're going to be relatively informal, more like a club atmosphere. If I could get somebody to volunteer, by the way, to do the accounting for this, I'll pay for it. If you want to start an investment club, I'll pay for the software. If I can get a volunteer, somebody who's got a financial history, by the way, you can't volunteer and say, I'll do it, and then expect me to teach you how to do it. That's not going to work. So you have to have some experience there. And because I've talked about doing this several times, and every time I did, by the way, this is where we got stuck. Nobody wanted to be the treasurer. Nobody wanted to keep track of that stuff. And there's software packages that will do it, but you have to enter it in, and somebody's got to maintain it. And and it is a pain. You're basically forming a limited partnership. You have to do all the paperwork, and it's all very official. So if somebody wants to give me a call, shoot me an email that you'd say, yeah, I'll volunteer, and you've got financial experience, and you don't need to be taught, then we can do that. If not, that's okay. We'll have these, I think we're going to do probably once a month or so, a little stock talk where we talk about these concepts, because I'm here to tell you, my industry has made this so complicated. It doesn't need to be. They make it so complicated. And I understand. I know why it happens, but it really doesn't have to be that complicated. And I think a lot of people would do a lot better with their investments if they understood the basics. And by the way, the basics, the fundamentals, it's 95% of what you need to know. The other 5% that's really complicated, what's really funny about this, you want to talk about an inversion. 95% of what you need to know is relatively simple, and the items are relatively few. The other 5% that can help you, absolutely, has an enormous amount of information that's not all that helpful. By that I mean, if you know all that other stuff, it's not going to help you much by coming to definite answers when it comes to investing in stocks. So you can learn the fundamentals, just the basics, and it's about 95% of what you need. And you'll recognize at some point in time, you'll recognize the areas that you don't need to really pay that close attention to, because you can be selective as an individual investor. You can be very selective as an individual investor and just avoid those things that are incredibly complicated. Now, here's what I mean by this. If I'm looking at two companies, and let's take Discover. I own Discover Financial Services. It's a credit card company. There are lots of reasons for that, but their major business is credit. That's what they do. They extend credit. Now, they have a few services in addition to that, but their primary line of business is running a credit card company. What do I know about that industry? Well, the industry's been around for a long time. It's very profitable. It's got very large profit margins. It's got inflation protection, because as prices rise and people still buy stuff on their credit card, the amount of revenue that these guys generate goes up with inflation. That's cool. That's really cool. I mean, how many businesses don't have that advantage? Okay. So if they're reasonably well run, they should maintain their profit margins. Their revenue should go up organically without even adding new clients. If they do add new clients, that's great. By the way, they need to, because that's the way businesses operate. Yeah, and I'm pretty sure they probably will, but you can't guarantee that. But when I look at that business, and then I look at a business, let's see, which one can I choose? It's a business that my mind is going blank on. Well, General Electric. General Electric has so many divisions, does so many things. They own insurance companies or financial companies that do financing. They used to. They spun a lot of them off. They own jet plane manufacturers. They're one of the larger locomotive manufacturers in the world. They have a semiconductor unit, interestingly enough. What do all those things have in common? Well, the only thing they actually have in common is that they're owned by GE. That's what they have in common. See, what I'm saying here is the businesses that they're in are completely different. And they're in a couple dozen that are completely different from one another. Do you know how much more difficult that is to try to make projections for? You've got to have all these heads of all these other businesses that you've accumulated in industries that are not related to one another, and you're going to try to come up with a fairly decent estimate. Now, people do it all the time. All I'm telling you is that it's harder, much harder. It's harder to be accurate. It's harder to go without surprises, which makes it almost impossible to come up with a decent earnings estimate, because the CEO really doesn't know until it's too late to do anything about it. When a problem arises, then he has to handle it. It's not like they can anticipate, world prices on silica sand changing, which causes the cost of the raw materials of the semiconductors they're making to go up, hurting their bottom line because they were worried about the locomotives or the MRIs that they make, the jet engines. GE is one of the largest jet engine manufacturers in the world. So that's what I'm talking about. And it's kind of, a lot of people look at that and go, why should that be so hard? Well, that's a problem, because if you don't understand why that's much harder than a company that has one primary business line, to make estimates for, then you should probably stick to funds. Realistically, you should probably stick to funds. And I get it. I understand it's difficult. It's more difficult for some people than others. And even when you know what you're doing, it's difficult. So don't feel bad. It's difficult for everybody. But the bottom line is there's some simple things you can do to help you. And as long as you get those simple things down, you're going to be good. You'll be prepared. You'll be able to evaluate risk in a fund. You'll be able to evaluate risk in a stock. And some of it's really simple. And I won't do it in this section, but when we come back from the next commercial break, to about 8 or 9 minutes from now, I'll come back with some examples that we can talk about, and can show you what I'm talking about. And you hear about a good fund. And actually, I've been talking about this now for a couple weeks, and I apologize. I was out all week last week, by the way. Most people did not know that because I have a home office. But I was out most of the day. Was ill from the trip I'd taken the week before. So if you didn't get a phone call back right away, you'll be getting called probably after today's show. I just completely, I hate when I do this to you guys. I lost my whole train of thought. Well, anyway, we'll come back to the last section of the show. We'll talk about the individual stocks. How do you identify stocks that are easy? I remember what we're going to do. We're going to talk about how do you look at a company. And when we come back from the commercial break, we're going to go into a little bit more detail with this, with some examples. But here's what I'm talking about. If you are an investor worried about running out of money in retirement, you're an investor, you're worried about running out of money in retirement, and you'd really like to know more about your investments, what I'm talking about here pertains specifically to you. Now, if you don't want to learn anything about your investments, you don't want to know anything about it, you better find somebody that you can trust a lot. Because if you don't know how to do this, you do not know whether your advisor knows. What's the best defense against being taken advantage of? Knowledge. It's what it is. So here's some knowledge, and don't panic if you miss this on the show. You can pick it up at 955thefish.com as a podcast. It's also on Apple iTunes as a podcast. You can go pick it up there, play it back. I'll be going over this stuff probably until I die, because this part's never going to change. This is a part of the fundamentals that aren't going to change. And you should feel good about that. This part's never going to change. So once you get this down, you can relax. Once you get this down, you'll be able to tell whether or not the people that you're talking to as an advisor know what they're talking about or have just memorized a script. I think that CFP commercial is pretty funny, where the guy with the long hair is a DJ, cuts his hair, puts a suit and tie on, and tricks all these people into thinking he's a financial advisor. Commercial is funny. It is funny. But, they're bringing home a point. If you don't know how to do this stuff, how do you know who does? If you don't know how to do this stuff, how do you really know who does? By the way, just because you have the credentials doesn't mean you understand it. You could be the memorizers. A lot of those out there. The memorizers. People that memorize the answers. And by the way, if you are dealing with a memorizer, this is going to become very apparent when they recommend a fund and you ask them to explain how they invest the money in that fund. That's going to become very apparent. Not that they have to have it memorized. They should be able to produce the documents and go right to the section that show you how the money is being invested, and they should be able to explain it. They should be able to do that. So if you're really looking, these other questions that I see floating around on the Wall Street Journal and all these publications online, they're useless. The vast majority of them are useless. It's a waste of your time. One of the things that really bothers me is somebody wasting my time. because time is something you never get back. Once you spend that, baby, it's gone. So don't waste my time. I get really upset by that. I don't get that upset, but not as upset as I used to. But it is upsetting. So here's what you need to know. Let's say XYZ company. You want to know how much money did that company make in the last 12 months, and is that normal? Now, don't panic. I'm going to show you how to. We're going to go over this time and time again because these are the fundamentals, and the fundamentals are not really going to change all that much during my lifetime. They haven't changed before I was born. They were the same. They'll be the same after I'm gone. So if I want to invest in a company, the first thing I want to know is how much money did that company make in the last 12 months and wasn't normal. Now, that number is called earnings per share. That's what they're calling it. Earnings per share. What the earnings per share number is trying to convey is how much you would get to keep if you owned every share of XYZ stock. How much would you have gotten over the past 12 months? Now, I know a lot of accountants out there and analysts are rolling their eyes now. That's much too simple. Don't worry, I'm not done. The earnings per share is the accounting language for how much profit did that company generate on a per share basis. So if they were to pay out these profits and those profits were accurate, how much would you get? How much does the owner get to keep? It's after taxes, by the way. So the earnings per share, that's what you need to know. That's the first thing you need to know. And you want to know, the next thing you're going to want to know is that normal for that company? And then that gets a little more detailed. And that I will wait until the after the commercial break because we're getting much closer to it. But you want to know, is that realistic? Is this a one-time thing? Where they had just had a great year, a great quarter that might go away, might not be repeatable? Is that company pretty steady? All those questions you want to get answered before you figure out what you should pay for it. Now, figuring out what you should pay for that, not very difficult, by the way. So, and let's assume right now that those earnings per share numbers, I've looked into the company, I've read the analysts' reports, I've gotten estimates from other analysts, which you can find all over the internet for free. Another thing we'll be doing in the Stock Talks, showing you where to access information like that, because it is kind of cool. That you can get all that stuff for nothing. You can get a lot of this stuff for nothing. Now, a lot of it's not very valuable, by the way, because the numbers are not kept up to date. There are some sources that are really valuable and aren't that expensive, and I like to use those personally. But anyway, so let's say I've got a company's earnings numbers over the past 12 months. I'm looking at the estimates. Everything looks okay. I've done all the work that I'm going to talk about doing a few minutes from now, and I can come back and okay, I'll accept that. I think last 12 months, they've earned about $1.20 a share. And I think that's reasonable. Why do I think it's reasonable? For all the reasons I'm going to tell you about 10 minutes from now. So I think it's reasonable. So now, like $1.20 a share is 5% of $24. What? Where'd that come from? Well, I'm going to tell you. I'm going to use the 10-year Treasury. The long-term average of the 10-year Treasury is right around 5%. If the number was higher than that, then I would use a number higher than that. But I'm going to use the long-term Treasury's 100-year average of right around 5%. And I divide the $1.20 by 5%, and I get $24. That's how I get that. In other words, we're going to have to wait for the commercial to be over, and then I'll explain that. I hear the music, so I got to take a real quick commercial break. This is Bill Bullington right here on 1420 The Answer. Stay tuned. And we're back. So we were talking about how do you know what a stock should normally sell for? And we came up with a number, earnings per share. That's the profits per share that an owner would get if they got to keep all the profits. It's an accounting entry, by the way. I understand. All you CPAs out there, keep your pants on. The number's an estimate. If they actually had to pay that money out, you can see those numbers will be changing pretty quickly in a lot of cases. In some cases, they'd be pretty good. Okay, so theoretically, earnings per share is the amount of cash that you generate per share if you own the entire business. Why is that important? Why is that important? Well, if you own a business, isn't it to earn a profit? Isn't that what you want to do if you're a business owner? Why would you put up with all that noise if there was nothing in it for you? Okay, so if you're going to own a share of a company, you need to act like an owner because you are an owner. You own a piece of that business. And the business owner always wants to know, what am I getting? If I own this company, what am I getting? So the earnings per share number tells you the earnings per share. If we decided to pay all this out, all you shareholders out there, all of our partners, all of our co-owners in the business, this is what you're going to get. This is what we got. This is how we did. This is how we did. Aren't you happy? Well, maybe. It depends on how much you pay for the stock. So I started off saying, what if we had a company that made $1.20 a share? Is that good or bad? Well, don't know yet. Depends on how much the share price is selling for. So if you divided $1.20 by 5%, why? Because that's the 100-year average of the 10-year Treasury, and that's what we like to use. Be relatively conservative. If you divide $100.20 is 5% of $24. Now I'm going to give you a little shortcut here. You don't have to get your calculator out and divide by 0.05 because mathematically you're going to get the same number if you multiply that number by 2 and then add a 0 to it. And you're going to get the same number if you just multiply it by 20, which is multiplying it by 2 and adding a 0 to it. So if I take the $1.20 and I multiply it by 2, okay, that's $2.40. If I add a 0 to it, it's $24. Get that? Now, this is why I'm doing this on a podcast, so you can go back and play this back. And I will put this out as a video, and this is going out next week to all the people that came to the seminar last Thursday. They're getting the special copy first, and it's free. Because you need to know this stuff. So let's go back. And keep that thought, by the way. You need to know this stuff. So go back to our example. If I paid more than $24, let's say I paid $48 for it. Well, $1.20 is only 2.5% of 48. Is that a good deal? 2.5%. I'm only getting 2.5%. I own a business. I'm taking all that risk. I have all those employees. I have to pay for all their health insurance and their pensions. I have to have all these customers that I have to satisfy in sales and marketing expenses, suppliers. Really? You're going to do all that for 2.5%? Shoot, I'll hire you. No, actually, I know I won't. You're not smart enough. I'm just kidding. Why would you take 2.5%? You're a business owner. You're taking all that risk. Why would you be accepting such a low return? Yeah, that's my point. 5% seems pretty low to a lot of people, and I got to admit, I'm not thrilled. If I own a business, and I guess today I would be happy, 5% is a maximum that I would like to go. Maximum low, by the way. That doesn't make sense, does it? Yeah, that's the least that I'd like to make is 5%. So if I wanted to make more than 5%, well, let's say the stock was only $12. Well, guess what? $1.20 is 10% of $12. Are you interested now? I am. If I could buy a business and I'm getting 10% on it, shoot. If it's a decent business, sign me up. Yeah, there aren't too many businesses out there like that today, by the way. So, in fact, right now, the average earnings yield, and that's what this is called, by the way, is the earnings yield. $1.20 is 5% of $24. $1.20 is 10% of $12. It's the earnings yield. That's the key concept. I've been talking about this for probably, 2 or 3 decades. I haven't really focused on it quite as much as I have lately, mainly because recently I read Warren Buffett use the same language. Are you listening to my radio show, Warren? I know he's not. But anyway, earnings yield, that's a key concept. Get that down. Warren Buffett's mentor, by the way, one of his mentors, Ben Graham, he wrote about this a long time ago, but he used language that you had to carry around a financial and accounting dictionary with you to be able to understand. I know because I used to carry one. My back is actually out of whack because I used to sit on that thing, and it was about 2 inches thick. It was one of those pocket dictionaries. I had to keep it with me everywhere I went. First 4 or 5 years I was in the business. But it was because these guys didn't speak English. They spoke accounting, and there's a difference. Earnings yield, by the way, you have to learn some of it. You've got to learn some of it. Earnings yield is a big one. And I think that if the entire industry spoke this way, that people would be much more successful in their investing. They'd be much more. And they would actually, one of the reasons that they'd be much more successful is that they would understand. Okay? So earnings yield, that's what we're talking about. Take the earnings per share, divide it by the share price, and it'll tell you what the earnings yield is. And what you're looking for is a 5% yield. Again, don't drive off the side of the road trying to write this down. You can pull up the podcast, 955thefish.com. And my goal over the next 5 to 10 years is try to help as many people be as financially successful as they possibly can be. So we'll be going over this stuff consistently. I'm going to put it out writing. We're going to do some videos. It'll be out there. And it's not as complicated as you think. I mean, is that complicated? $1.20 is 5% of $24. Not that complicated, right? So $24 is kind of I wouldn't want to pay a whole lot more than $24. Now, in some cases, businesses will pay, or people will pay a lot more than $24 because they're confident that the business will grow. So they might pay $48. That's a high level of confidence. And they better grow because you just paid an awful lot of money for a company with a relatively small amount of profit. Does that make sense? So that's kind of the general rule of thumb. Look at the earnings yield. If you think you can trust the earnings per share, that's another issue. We'll have to come back to that probably on another show. Because right now I think I'll take an example of this, and I like to use Procter & Gamble a lot because Procter & Gamble has a whole bunch of products that we use, that I use quite frequently. If you go to their website, you can see it. Procter & Gamble symbol is PG. So I'm going to this service that I use. It's called Y-Charts. I look up the earnings per share in the last 12 months. They were down quite a bit from year over year. They were down quite a bit. Now, there are some reasons for that. Procter & Gamble sold some stuff. Took charge against earnings. But right now, let's say I didn't know anything else other than what the earnings have been in the trailing 12 months, $3.75. Okay, so if I multiply that by 2, I'm getting somewhere around $75. Yeah, somewhere around $75. And I probably should have done that before I even started here. But it's around $75. The stock's at 80. Am I excited about that? Not really, because what I would like to pay for it would be slightly less than what it's currently selling for. $75 is what I'd like to pay. But here's the thing. Procter & Gamble's pretty good. The revenue growth year over year was only a little over 3%. I know they got rid of Gillette not too long ago. I know that because I read the management's discussion. That's something we'll talk about next week when we're talking about looking into the earnings. Okay, because we're going to do that next week. Looking into how the earnings are calculated. Looking into whether or not the earnings are normal. You'll hear the phrase normalized earnings talked about a lot on financial shows. That's what they're talking about. Under normal conditions, how much would this company actually make? Okay. What kind of earnings per share could you count on under normal conditions? Now, having said that, you really can't count on much of anything in this world. You're coming up with an estimate. You want a good estimate, not a crappy one. And you can see when you start doing this, you're going to find out when analysts are not very good at their jobs. I just got an email from somebody. By the way, you can email me, bill@bullingtoncapital.com. You can actually do it during the show. I'll even read it. And somebody did mention something about, I was talking about semiconductors, and geez, I only have so much time left. So we're going to continue the earnings per share conversation on the next show. And I just want to tell you that semiconductor industries, you might want to look into that, look into adding some of that to your portfolio in some way, shape, or form. I'll have a report coming out on that next week. But now that I hear the music, I just ran out of time today. Sorry about that, but I'll be back next week, 11 o'clock, right here on 1420 The Answer. You're listening to Bill Bullington. I'm here every Saturday morning from 11 to noon. Have a good week, everybody. Good luck and good investing.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420 The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly, will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional. The preceding program has been paid for by Bullington Capital Management, LLC.